Let's focus on the bigger story of the day, which has to do with insurance. The insurance bill is ready to see the light of day. The Select Panel on Insurance has tabled its report in the Rajya Sabha today. Well, they're recommending a composite cap of 49%, and that cap should include all foreign investment as well as foreign portfolio investment, so FDI, FPI, as well as NRI. The committee is also of the view that incremental equity should ideally be used for the expansion of capital base. That is, to go from 26 to 49, there should be fresh money coming in. Let's listen in to committee members Rajiv Chandrasekhar and Naresh Gujral on what the rationale was behind these caveats.
The composite cap is a simple point, which is that the 49% should include both the FII and the FDI investment. And the reason for that is that that is what is consistent with other sectors. There is an argument that FII should be kept outside the cap, but I think that reform has to be something that is separate from the insurance bill. The issue of bringing in capital into the company in terms of expanding the 49% equity is something that Naresh has raised very strongly in the committee. That is consistent with the desire and the objectives of raising the FDI cap to increase penetration and to increase FDI.
The basic reason why we are taking it up from 26 to 49 is that we want to give financial muscle to the companies so that there is greater penetration. Now the idea is to strengthen the companies and not give windfall gains to a few select individuals in this country. You may recall that at the time of 2G, this is exactly what had happened. There are a few individuals that gained. So we want money to go into the companies and not into the pockets of a few rich individuals.
Well, that may be the rationale, but will these caveats hurt foreign investors in insurance? To discuss that, we're joined by SHASWAT SHARMA, partner at KPMG, and also joining us on the phone, ABIZER DIWANJI of EY. Gentlemen, good afternoon. SHASWAT, I'll come to you first. The committee seems to have recommended that ideally any move up from 26 to 49 should only be via fresh capital. Now, the notion is, idealistic, but what does it mean for, those joint ventures that already exist right now?
So, I think the point is very clear in terms of the existing joint ventures. With fresh capital being infused in the country, the need for the growth capital, the need for setting up new channels of distribution, for being able to penetrate much deeper beyond the top 25 to 30 cities as of now, that's going to be given a real impetus with the guidelines. So what we've estimated at KPMG that if we were to look at fresh capital coming into the country and fresh capital being infused into the insurance business across both life and general insurance, including health, we expect between 20,000 to 25,000 crores of rupees entering the market.
But
now,
will it make
capital is something which will really help expand.
Shashwat, will it make some of these companies overcapitalized given the current stage of the business? And if it's going to make them overcapitalized, will the money come in at all?
So I think each company has to think through a very different strategy. So as we are aware, there are close to around 45 companies across both life and non-life who would be impacted with the FDI regulation going up. Now, in that context, I think each company has to take its own view in terms of would the foreign shareholder, who's the current JV partner, increase the stake to 49, or would they want to bring in the FII money or the FPI money? Would they want to go public in the near future and being able to raise the money in the capital markets and also get the FIIs to come in? I think that strategy has to be very specific on a case-to-case basis. So I would say at a very generic industry level, it would definitely help new capital, growth capital. Also, I think one point to note is that some of the new players who have just entered the market or are looking to enter the market. Now, some of those players need significant capital over the next 5 to 7 years. And there are also a lot of new players who are still waiting in the annuals to see when they should enter the market. Now, those players bringing in fresh capital along with the other players who have recently wanting to expand but were strained and constrained by the capital would be really good. Also, a point to note is in the new guidelines, and we need to wait for the final guidelines to be tabled and be passed by Rajya Sabha. They're also talking about health insurance companies needing only 50 crore of capital rather than 100 for life and general. If that happens, I see a lot of new health insurance companies coming to India in a very big way. So all of that would be very positive from an overall capital being infused in the country and infused in the insurance sector.
Okay, all this sounds very good, but let's also try and examine what it means for existing structures. ABIZER, would it be fair for me to say that several foreign partners might not be very delighted by this caveat that, any raising of the limit or increased investment would have to be via fresh capital, because many of them have already indirectly funded these ventures through the domestic partners on the premise that, when the FDI cap is raised or when the limit is raised, that funding will get converted into equity to represent their increased stake in the business.
So, not only the foreign guys, but even the domestic guys. I think everybody, for everybody, there were structures that were existed. There were structures which have been approved by the IRDA itself. And frankly, yes, many of them envisaged a secondary transaction.
Which is so let me just be clear. When you say secondary, that you mean that the domestic partner selling equity to the foreign partner, not an issuance of fresh equity by the joint venture company.
That's correct.
Yeah.
That's correct. That's correct. So we expect a lot of the transactions were based on the premise that there would be a secondary transaction, and that would be kind of now difficult to execute. While of course there would be ways to infuse fresh capital and do some kind of a buyback. There could be various other means by which people would do it. I think the moot point to understand here is that any kind of capital that needs to flow into a company cannot be dictated by a particular amendment bill. So frankly, the larger point here would be that they should allow companies to take their own capital decisions. Now, irrespective of whether a domestic partner has to be paid through a secondary mode or no, if an insurance company needs capital, it will find ways of getting capital. Frankly, and there are many businesses who have very high solvency ratios and hence don't need capital. And there are many others who absolutely need capital, in which case they will do secondaries or they will do primaries. But there are many others who frankly do not need capital.
ABIZER, even the negative impact on the domestic partner, as you're pointing out, is actually a negative impact on the foreign partner, because if I'm correct, and this is anecdotal research, many of the domestic partners were bringing in capital based on indirect funding from the foreign partner. So actually, it's the foreign partner's money at work. Now, if the domestic partner is not able to exit via a secondary transaction, then it's actually the foreign partner's money that's stuck, right?
No, yeah, that's you may be right. That is anecdotal because that is not evident.
Is it not evident in the transactions or the agreements that you witnessed?
No, frankly.
I can see the smile on your face. So, I mean,
there are many kinds of agreements, Menka, that are in place. And frankly, there are a lot of people who have invested their capital and frankly need an exit. Even the domestic guys have been here for 7 to 8 years in this business, and they may need an exit.
Maybe the only way to do that exit, is an IPO then, because that seems to be the only option on the table, or find other, domestic investors or private equity funds or long-only funds. For instance, Shashwat brought up the issue of SPI wanting to invest in unlisted joint ventures. That is possible, but with a bunch of restrictions, right?
Absolutely.
Yeah.
So frankly, all my larger point was that you should not allow, you should not have any restrictions on funds coming in through a bill. Let the funds come in freely, and I think capital, if required, will come in even on a primary basis. And if not required, will go out some other form, even if after it comes into a primary basis. So frankly, there will be various means that people will do.
Okay, but outside of what this means on a structuring pain point, ABIZER, do you see it sort of substantively impacting the country's ability to bring in more funds? Because I think that seems to be the goal of a hiking in FDI limit. That seems to be what the committee members are talking about. Do you think this structuring pain point will sort of force some foreign joint venture companies to rethink their presence here, or any of such extreme nature stuff? ABIZER, have we lost you? Okay, I think something's gone wrong with that phone line. Let me redirect that question to Shashwat then. Shashwat, do you see any of this structuring pain point proving to be a big substantive deterrent to foreign players?
So, I think what we need to really understand is that where is the insurance sector at this point in time? And I would say the answer may be different in the context of each company as well as in the context of each line of business. So for example, if you look at the health insurance side, or if you look at high growth which we are seeing on the motor insurance side and also on parts of the life insurance, I think from an overall perspective of India, and if you look at a much bigger macroeconomic view of the country, we are grossly underpenetrated. There is hardly any protection in the informal sector. So I think we need to think beyond just the interests of a few.
But these are the people who run the businesses, Shashwat, and if they're not comfortable with the structures. Yeah, but they're the ones who run the business. If they're not comfortable with the structures, then, you know, so any potential of bringing more money in is stymied to some extent. Yeah. I don't want to overplay this. I'm just saying to some extent.
Yeah. No, I take your point, but I think the point to note is that whenever any corporate or any company enters into the insurance business, and I work with a lot of them on the business strategy for them, you always take an outlook of minimum 10 to 15 years. So obviously, if the idea is that you're looking at 10 to 15-year view, and you're saying, look, for 10 to 15 years, the company will drive a strategy to increase penetration, to reach a much wider base of customers, and the metric of return on equity is very important. And absolutely, I take a point in terms of what the investor expect, but that is value which is locked in the company. So the point I'm making is that if after 15 years, 16 years, we have an IPO and we're able to unlock it, that's great. But really the point is that you're still retaining significant value in the company. So if you look at the ROEs, and this is all in the public domain from IRD and other websites, most of the non-life companies are in their high 20s in terms of ROEs, which I think is a very good return for any investor. So if you look at almost every large insurance company, the ROEs are upward of 25%. If you look at the values and the market cap, and if you look at the Indian shareholding, and this morning I was in another TV channel which is actually tracking the stock price of some of the large Indian groups which hold equity in life insurance companies. Almost all of them are seeing a boom in the market. So I think there are a lot of other factors need to be considered. So I would not look at only as a structure as a constraint. So I think that's the view which we have.
Okay, fair enough. Well, we appreciate that view. Thank you so much. It's also moot to see whether all of this language in the committee report will get translated into the bill. We have to yet see that. There are RBI pricing guidelines that will get factored in. So we'll wait for more to revisit this discussion. But that's it for now on the insurance story. We'll get back to the breaking news.
I think it's important to understand that they say they recommend. They haven't really. They haven't used the final word.
They've used the word ideally they should be linked to fresh capital.
Yeah.
Therefore, I said, let's see how this reflects in the bill. But it does seem that, you know,
that's the thinking.
that's the thinking at this point in time.